Good morning, everyone, and thank you very much for joining me. This is the morning market review. It's Friday, it's the 30th of September. My name is Russell, I'm a senior market specialist at FXCM, and my email address is r@fxcm.com. I'm just bringing up the high risk investment warning. I just want to double check after yesterday. Can everybody see my screen? Just want to make sure everyone can see my screen and hear me. Just let me know. Okay, good. Alrighty, let's bring up the market commentaries disclaimer. Hey Anna, hey Rob, morning to you. Thank you everyone for joining this morning. For those that are attending the day trading workshop, I'm hoping that you guys are enjoying it. I re-recorded the beginning and just sort of edited as best I could. Not a video editor by any means, but tried my best. And everyone that attended, you'll get a link to the recording. It is on YouTube, but it's unlisted. You'll get the link to that fairly soon. All right, here's our references: MarketScope 2.0, TradingView, and Bloomberg. In terms of Bloomberg, we're just going to go through the daily email they send out, 5 things to start your day. They actually send it out. There's a European edition, there's a US edition. So clearly this would be the European edition. And the first headline is, oh, okay, cool. So nice feedback from Rob. He's actually starting to use it with some small positions with some success. I actually got an email from somebody asking, have we tested it, etc. And whilst there has been some testing, I think the whole idea was, whilst I think there is a certain practical element to it, is it has to be turned into everybody's got to make it their own. Everybody's got to adjust it, make it their own. So it's mainly sort of the education, take it away, and then you mold it into something that hopefully is workable. But that's great feedback there, Rod. All right, let's bring up this chart here, which I think is a good chart for us to start. But let's go through the emails, the Bloomberg email. And the first headline I think is very important. It says, "You got the message." So Federal Reserve officials reiterated that they will keep raising interest rates to restrain high inflation, and that markets are now understanding the message. St. Louis Fed President James Bullard told a virtual emerging market forum that volatility in financial markets reflected spillovers from recent events in the UK, where the new government's fiscal measures have seen the pound plummet, but made clear that these would not cause the Fed to pause its tightening campaign. His hawkish stance was in line with the message from Cleveland Fed Chief Loretta Mester, who said that officials are resolute in their quest to increase rates to a level seen as restrictive. Keep that sort of first story in mind when we go through this chart over here, which is of course the chart that we generally start our webinars off with as of late. But I think there's a story here. We'll get to it in a moment. Next headline reads, "Under fire. Kwasi Kwarteng privately pleaded with his angry colleagues in the UK's ruling Conservative Party to support the government's economic policies, warning that any division would play into the hands of the poll-leading opposition Labour Party. Groups of Tory MPs have spent 2 days in frantic discussions following a dramatic £65 billion intervention from the Bank of England to avert a meltdown in the bond market. The fallout represents a political crisis for both the Chancellor and the Prime Minister, as it undermines the Tories' typical claim to be the party of sound economic management. The pound, meanwhile, rallied early Friday and briefly erased all of the losses it made since Kwarteng began his speech last week. I think, let me write pound down. Let's take a look at it. Remember the last time we did an analysis on that, so we'll take a look. Hey Howard, morning to you. Nice to have you on the webinar. Meta's reorganization. Meta platform CEO Mark Zuckerberg outlined sweeping plans to reorganize teams and reduce headcount for the first time ever, calling an end to an era of rapid growth in the social media giant in what could be the first major budget cut since the founding of Facebook in 2004. Zuckerberg said the company will freeze hiring and restructure some teams to trim expenses and realign priorities. Meta will likely be smaller in 2023 than it was this year, he said. The further cost cuts and hiring freeze are Meta's starkest admission that advertising revenue growth is slowing amid mounting competition for users' attention. I think this is a point we need to discuss, so I'm just making a note there. Next headline reads, Ukraine advances. Russian President Vladimir Putin may not have long to wait for the first major test of his decision to annex a swath of Ukraine, with Kiev's forces threatening to encircle a pocket of the Donbas region he set out to conquer. The Kremlin said Putin will on Friday sign what it called treaties with the Moscow-anointed leaders of 4 partially occupied provinces in Ukraine's east. Ratification of their absorption into Russia would soon follow. Yet, even as Putin prepares for a significant escalation of the conflict, Ukrainian, Western, and Russian military analysts say Russian units are at risk of being enveloped in the Donetsk town of Lyman. Last paragraph, and then we'll get into the chart analysis. Just coming up for the day, European equity futures fluctuated amid declines across Asia as the prospect of higher interest rates and turmoil in Europe stoked fears of global recession. EU energy ministers meet in Brussels on the power crisis. Tesla hosts an AI day designed in part to lure more engineering talent. ECB Executive Board member Isabel Schnabel takes part in a panel discussion in Spain. Fed Vice Chair Lael Brainerd and New York Fed President John Williams speak at a conference. There's a flurry of economic data ahead, including CPI and PPI inflation for France. CPI came out for Germany yesterday. It was high. We're going to see Spain retail sales, UK GDP, which is probably out. Carnival and Cineworld report earnings. All right, so the news is, I think, quite intense this morning, and I think it's important, all important news. All right, let's start off with the real rate, and then just have a discussion. I think we must take a look at the pound, see if there's any sort of technical analysis that will help us in any sort of way to exploit opportunity. I think a discussion around Meta, not so much as in looking at Meta, but just talking about this in sort of a broader macroeconomic context. I think that would be useful. Anna writing, the VIX is finally starting to awaken. Let's take a look at the VIX as well. Nice one there, Anna. All right. So real rate. Yesterday, the bottom chart has the NASDAQ. This is a daily chart. We usually look at the weeklies, but I thought it would be useful to take a look at the daily because there's a steep sell-off yesterday in the NASDAQ. The reason I love the NASDAQ is because it's the index that's most sensitive to interest rates because of the time value of money. We're not going to get to that this morning. Let's just take a look at the Dow Jones as well. All right, so there's also there was also a sell-off in the Dow yesterday, and but there's a blue candle. There's a blue candle in interest rates. But not only is there a blue candle in interest rates, there's a big gap from where we closed 2 days ago to where it opened. So there certainly was an interest rate increase, but this candle here is actually it's almost there's a hidden aspect to it, just how vicious this candle actually was, because we closed here on Wednesday and we opened up here on Thursday, yesterday. So there's this big jump up in yield. Even though this candle is a blue candle, but it's not the most the most emotive candle we've ever seen. The emotion in the sell down on Thursday is apparent, not so much except for the hidden element of the gap. And I think that gap really sort of spooked the market. So the causality here, I think, is important. We can't ignore the fact that as long as interest rates continue to move up, there is going to be an effect on the risk market because of the time value of money. Again, I don't want to get into the maths today. We can probably, I think we should do it next week. There's also, so that's one aspect, and that's causing a rotation of capital into safe havens. So that's effectively what's happening. Bear in mind, we still got this overbought condition on the weekly that needs to resolve. Now, because it's a weekly, as we said just like, it's very difficult to actually look at it in terms of timing. Technical analysis generally, has a huge emphasis on timing as opposed to, say, fundamentals. But the fact of the matter is, timing an overbought condition or an oversold condition on the weekly is almost an impossible. Timing in and of itself is very difficult, but on a weekly chart, it's nigh impossible, right? So we're gonna let's just bring in the overbought condition just to highlight what we're talking about here. Sorry, let's go to the weekly. So this is what I'm really interested in. How long it stays above 80 is anybody's guess, but it's going to normalize at some stage. When it normalizes, there either is going to be a plateau here. There'll either be a plateau in real rates, or there'll be some sort of pullback. The two, one of the two. Generally, when we hit overbought conditions before, so here's one. It was very brief. We had 3 weeks of red. Over here, there was a delay. So there's a delay. That's the weekly aspect, right? But then we get a pullback over here. This pullback over here actually is very interesting because again, this was a mistake by the Fed in terms of their communication. It was the July press conference, most likely misinterpreted by the market, but using the word neutral sort of too soon, sort of loosened up market conditions, and then the Fed just had enough of that, and they've gone super aggressive, and that's kind of where we are now. And that aggression started at Jackson Hole, right? So that's kind of what we're seeing. If we get, let's just bring in, the Nasdaq here underneath, just to sort of complete this thought. All right, so this is interesting. Here you've got pullback, and then only the Nasdaq sort of jumps up. So there is a lag here, then it moves up as the real rate comes down. And then again, over here, as the real rate comes down, Nasdaq responds positively. In other words, what I'm suggesting is that if there is any sort of pullback in the RSI, and I expect there has to be some sort of normalization, it's just the timing is difficult. Do we see it over the 13 weeks of Q4? I'm thinking we do, but that's sort of more a, it's unsubstantiated. So we're just going to have to monitor. But if we get this pullback here, then Q4 potentially has this bounce in all of this bearishness. I think Q4 is setting up for an interesting end to a very tumultuous 2022. In other words, maybe risk markets in the year of going into the Christmas season quite on a positive note. But I think, as mentioned yesterday, that's really going to play with our market psychology, because then we're going to be second guessing. Are we at a bottom? Is this a dead cat bounce? And it's going to be, I think, quite a stress trying to pass our way through that. We'll see how that plays out. Before we take a look at pound and have that discussion on metal, let's just go to the VIX. We haven't looked at it for a while, so thanks, Anna, for bringing that up. Let's just see if there's anything that we can glean from it. All right, and let's make this the S&P. I'll tell you, if anybody is a little fuzzy on what the VIX is, I'll explain it to you in a moment. It's actually quite a useful series to watch. It's known as the fear index, and oh, okay, and it says it was the Bloomberg newsletter. All right, I missed that part. All right, so what the VIX is effectively it's a volatility index that's based on the options market of the S&P, of the companies within the S&P 500. Okay, so the VIX specifically relates to the S&P 500, but the S&P 500 generally relates to the economy. So it's worth watching sort of on a macroeconomic scale as well. Effectively, as it ticks up, as it moves up, okay, that is the market building up put positions. What does it mean, building up put positions? So a put option, effectively, the easiest way for me to explain it is effectively like an insurance contract. So think about it sort of in terms of our car insurance, like short-term insurance. If something happens to our car, let's say we're in an accident, the insurance policy puts a floor in how much the cost actually is. So we'll pay an excess, and generally, hopefully, if the damage is not too bad, we get it repaired. That's effectively what a put option is doing. If the market is selling off, the put option provides protection. The mechanics, I think, again, we'll leave for another time. We do have a series on options, which we did quite a while back. If anybody wants that, email me. I'll see if I can dig it up. But at the same time, okay, if it's moving away, then there is a build-up in what we call call options. Call options effectively are positions where you are anticipating better times ahead. You're anticipating better times ahead. So what Anna is saying here, she's saying the VIX is firing up. It's moving up as the insurance is being built up by portfolio managers. Why is the insurance being built up by portfolio managers? Is because their portfolios are in real danger now of decline. So they're starting to protect themselves, right? And you can see this is creating quite nicely. So that's what Anna's talking about. The VIX has just woken up. Now, what's interesting about the VIX is that technicians, and I would say not only technicians, I would say there'll be a fair amount of market participants actually look for contrarian indications off of it. So let's just bring in more of a history here. And I'll make this logarithmic. Let's take that out. So what do I mean by contrarian? So this is the 2008 crises here. Okay, so this is global financial crisis. This is COVID. Here's lockdown. Here's lockdown. So you can see these spikes up in the fear index here. There was huge buildups of these put positions to protect portfolios. But when it reaches extremes, there is a theory, it's a contrarian type of signal. In other words, it's probably a signal that the market is bottoming out, and you can start looking for bargains. So where is the level where contrarian activity seems to manifest? I haven't seen any definitive answer. I've seen some say 30, so I reckon 40 is kind of the level that we can start seeing. So 40 here, 40 here, it's shy here. So if what I'm saying has any sort of I guess validity, and if we're going to reach the 40 level, that would suggest potentially more weakness to the downside. So that's what the VIX is telling us. So we'll carry on perhaps keeping an eye on that, but that actually leads nicely into the Meta story, and then we'll do pound afterwards. So Meta's restructuring. Okay, Meta's restructuring, and I think that's fascinating because, of course, the FANG stocks were market darlings, weren't they? So let's bring this across. The idea here is, there's a few things I think just to show here. The first thing, let's do the phases of a bull bear market. I think this is something that is super important. So just keep this, I guess, file this away because I think it's important. So your bull market tends to look like this. There's 3 stages. Let's just give this some names. So you've got renewed confidence. This comes from Dow theory, just to give you context. You've got renewed confidence. Then you've got improved earnings. And in the final stage of the bull market, this is probably, yeah, we can do that. It's called rampant speculation. And by and large, I think that there is, a good model for this. Whilst I don't think all bull markets would be sort of strictly speaking following this, I think it's a good way to follow the market. The improved earnings is generally the longest and the safest time to be in a market. Rampant speculation, if I'm wrong, is the most lucrative, but it's also the most dangerous part of the phases. Once that's over, we get something called the abandonment of hopes. Okay, then we get worse earnings, and then sorry about that. We get worse earnings, and then we get something called capitulation or panic selling. So I'll just put that in. So we clearly passed the abandonment of hopes, right? Abandonment of hopes is where you come into the market. It's a very speculative part. You expect to buy a financial asset and sell it at a higher price, but the last buyer has effectively been pulled into the market. You can't get out at the price you want, and sort of your hopes start getting dashed. But then what happens is we move into decreasing earnings. Okay. And this is where the Meta story sort of fits in. They're restructuring because they need to make sure that the earnings aren't too badly hit. And then of course after that you got the panic selling. And the obvious question is, where are we in this cycle? And you know, are we in decreased earnings? Have we seen the panic selling? So I think that we're kind of getting near the bottom, but I don't think we've seen the final capitulation yet. That's what I'm worried about. I think as we go into Q4, I think it's sitting up for a good quarter. I'm going to tag on that subject to correction because I don't know, but I'm thinking if the real rate does normalize, it's setting up for a good quarter. And then I think maybe we're in danger of this sort of panic selling when the Fed sort of pushes back against that. It's very much speculation at this stage. We'll have to analyze this week by week. But the fact that Meta, you know, a previous market darling, is restructuring, you know, kind of puts us really, and we've seen just a whole lot of bad corporate news come out, aren't we? So, but we got to try and be strong enough to assess when the panic selling stage is over and when renewed confidence is in, and that's going to be really tough. One more thing just to say about an inflationary environment and why Meta is needing to restructure. I'll see if I can articulate this. Let's just say there's a company that is got a sales of 100. Let's just say its cost of sales is 50. Okay, so it's what we call the gross margin here would be 50%. Okay, be 50% because sales minus cost of sales would give you a gross profit of 50. Okay, let's just put this in here. All right, let's just say sales have increased. A big one. Let's just say costs have increased. Let's say costs increased by 10%. So your cost of sales, let's say cost of sales increases by 10%. So we've got now a cost of sales of 55. Now the company's got a choice here. Do they weather the storm? Do they absorb the costs, or do they pass those costs on to customers? So let's just say they decide they're going to pass those on to customers. So then they would have to raise their prices by $5, right? Okay. So it's all looking pretty good from the company's point of view because effectively your gross profit is still 50. So you're not really worse off. Or are you? Or are you? What's your gross profit here? So this over here is what we call gross profit margin. Sorry, what's your gross profit margin here? How do you work that out? It's your gross profit 50 divided by 100. Okay. 50 divided by 100. Okay. What's going to be your gross margin here? Okay, look at this. 50 divided by 105. Okay, so what does that give you? Okay, gives you 47.6%. Isn't that fascinating? So even though you've passed your costs onto your customer, you're actually worse off because you've got a lower gross margin. So that's what inflation does to companies. It's going to make their margins come under pressure. So that's what Meta's trying to do. They're trying to control the sort of the environment, and one of the ways is to restructure. All right, let's go into pound US dollar. All right, so what I have here is clearly a downtrend. This will be on the weekly chart here. So we've got a lower peak followed by a lower trough, lower peak followed by a lower trough. That's probably the last time we looked at it. So we can add in here another lower peak in the series, and we can throw in another lower trough in the series. And the volatility here has been extreme. So you can see the way that the pound has tracked for this week, because this is a weekly chart. So this is putting in our axes. Okay, so here's the open. Here's the open, round about there. I haven't quite got it to scale. Then there's just this massive capitulation. This massive capitulation. And then the craziest market action after that is that it pushes now right up, because the close is above the open, right? So you've got this huge bearish movement. Bears lose control at the low for the week, and then it's all bulls pushing up. So you've had some extreme volatility in pound. In fact, when we looked at pound in our day trading course yesterday, it was actually showing positive signs. The signs weren't particularly clear. If you recall, we were sort of just on the cusp of the daily and the hourly synchronizing. Okay, we don't, so we couldn't really see sort of an outright bullish sort of moment at that time. We were holding the webinar, but there's no doubt that after that it just, it moved up. So that was on the day trading system. Look at it on the primary trend basis. What's happening on the primary trend basis? Primary trend basis is not looking particularly good. It's looking very fragile. Okay, we're down here, a series of lower peaks followed by lower troughs. How do we get pound strength from here? Well, you could have a miraculous movement up like this. Again, I don't think that's likely. We call this a V reversal. They are extremely rare. I mean, they do happen. Off of the COVID lows, I think we had sort of very close to V reversals in a lot of instruments. But generally, they're rare. Moreover, the V reversal in of itself, really, in terms of strict definitions, doesn't put pound into an uptrend. All it does is it ends the downtrend, because you don't have the series of lower peaks, lower troughs. You would have a higher peak if we got this. The movement of a higher trough, higher peak would be the best technical pattern to show sterling resilience, which is effectively a head and shoulders, isn't it, at the bottom? So there would be the left shoulder, this would be the head, and this would be the right shoulder. Again, very much speculation now, but this is kind of the pattern we would need to see in terms of cable showing strength. Of course, given the rampaging dollar, okay, we must be aware of the fact that we might get a lower peak followed by a lower trough, and we might get that breach below parity. And the longer that we stay under 20 or break, if we return to 20, then the stronger the I guess the possibility that parity gets tested. However, okay, there is the overbought condition to consider in the dollar. Again, I don't know when that's going to normalize. I feel that we have to watch it extremely carefully, but if that overbought condition starts normalizing, then the pound has been battered. It's black and blue at the moment. Well, it might attract sort of, dare I say, a value crowd into it, and we might see cable actually perform quite well in Q4. Again, I don't think that's the end of the story. It really depends on US monetary policy, and it depends on that median inflation, right, that we've been talking about. However, the parity position here, again, I'm not convinced, again, going to tab on that subject to correction, that it gets breached in any meaningful way. Not until there is a platform set up for higher dollar prices. And how does that platform for higher dollar prices set up? I think the real rate has to effectively normalize. This is all very much sort of hypothetical, hypothesis, but I think there is something to it which is worth monitoring. Either it proves to be correct, or otherwise, it won't. We don't want to forecast. We just want to measure if there's anything to this sort of hypothesis. Again, I must come back to what Gertie brought up on Monday. What about the bond market? And I think that is actually a key part of this whole discussion, in that it doesn't make sense for real rates to come down, because the environment is just too tight. There is just too much hawkish rhetoric coming out of Fed officials. So I think the only way that the hypothesis potentially plays out is if there is some sort of movement on the bond market. And I don't think that is a stretch. I don't think that's a stretch, because it's just been obliterated, and prices don't move in that straight line. We know that prices move in those ebbs and flows. We know there's that heartbeat. And see, this is a waterfall structure here. It's an outright capitulation. It's kind of vertical, At some stage, there has to be some support, I would think, coming in, and that support effectively supports bond prices. Bond prices get supported. It would suggest yield prices start putting back. That might be that catalyst that sort of leads to the potential dead bounce in Q4. Be hypothetical at the stage, but it's something that I want to monitor with you guys over the next few weeks, just to see, is it correct, is it incorrect? If it's incorrect, can we reset and carry on sort of in the bearish mindset? If it does show signs of bear market rally, can we capitalize on that? And that's going to be quite a trick. All right. Any questions around that? Any questions? I was just writing. I'm sure someone has pressed the basement button on the markets. Yeah, that's for sure. That's for sure. Any questions? Please go ahead and type those in. All right. I don't see any questions coming in, so I think we can conclude at this point. Have a good day ahead. Have a good weekend, and we shall speak then on Monday morning. Thank you very much, guys.